track record. If you look at his website, Boom Boss blog, you'll see that he predicted a number of events before they happened, like the collapse of Bear Stearns 2 months beforehand, as well as the fall of Lehman Brothers before anyone even had a clue. Reggie also appears regularly on television stations, CNBC, Bloomberg TV, CNN, BBC, and he even made an appearance on a Dutch documentary, Tegenlicht, produced by VPRO last year. And that is also, you can see all these videos on his website. Reggie describes himself as the world's leading realist, but be warned, he can be offensively honest when he needs to be. May I have a warm round of applause for Reggie Middleton?
Thank you. Can you give me a note at 10 minutes? Thank you. Good afternoon, everybody. As was noted, I just came in from an 8-hour flight from New York, sleep deprived. So as a New Yorker, we tend to speak very quickly. And this is my first presentation in front of a crowd where English is not the primary language. So if I'm moving too fast, simply a quick nod, okay, and I'll try and slow down. I'm here as an intellectual antagonist. But let's take a look at what's going on in Europe from my humble perspective, of course. Here we have the aggregate trading book of banks in several different sovereign nations, okay? You have this, it came from the first and second set of European stress tests, okay? You have a category called the trading book. AFS is for sale securities. You have the banking book, which is what the banks intend to hold to maturity, that they don't intend to trade. They're going to keep it and hold it until the bonds, and these are mostly bonds, mature. And then you have the total book. During the stress test, the major risk to the banks, at least from abroad, is that they are at risk from markdowns on sovereign securities, sovereign debt. And they buy the sovereign debt using a standard banking model. They take $1 of equity, they lever up, they borrow $10, and then you borrow $10 or $11 worth of sovereign bonds. Many of these bonds in the market have dropped 5, 10, 20, 30%. Greece is a very good example. You take $1 million, you lever up 10 times, you have $10 million, you buy bonds, the bonds drop 32%. How much do you have left? Rhetoric question, okay? So here you have Spain, and this is using the EU's numbers now, right? They expect a potential worst case scenario of a 12% haircut in Spain, 23.1% in Greece, 7.4% in Italy, on down the line, okay? The banking book, you have aggregate exposures in each one, and the total trading book. The stress tests only focused on the trading book. The trading book is roughly 10% for Spain, roughly 10% of the total exposures of the banks. So they have a total haircut value of 2.6 billion euros. Okay, but wait a minute. If I have a total of 2,500 billion euros, but I'm only exposing 2.5 billion, that sounds like a good deal. Let's suppose Spain, or someone who's more likely to default soon, Greece, does default. Do they default on just what I call the trading book loans? Or do they default on everything? Greece doesn't really care how the bank labels it. A default on a loan is a default on a loan. If Greece defaults or restructures, they change the terms of the loan. They give a haircut, a discount, which is what we call a haircut in the States, of say 30%. Okay, the banks are levered up, the banks take a loss. If you just divide the banking book by the trading book or by the total book, you can see the losses are underestimated on the stress test amounts by significant amounts. Here, Spain's losses are underestimated by 92%. Greek banks are underestimated by 80% on down the line. These are the averages for the euro area, the non-euro area, and the European Union as a whole. This is significant because this explains why the banks are actually so reticent in lending money. I think that's a politically correct way of putting it, hopefully. Now, what we did, I had my team of analysts, we recalculated the discounts or the haircuts to be had by the banks because it was my opinion that they're a tad bit optimistic. Okay, that's an exaggeration. They were extremely optimistic. Here, nearly every debt-laden EU country that expressed they had a problem or suspected of having a problem has received extremely optimistic treatment from EU statisticians. Here we have Greece, and we have Greece's real GDP growth. What I did was I graphed the real GDP growth of Greece against the EU estimates. Here's when the problem started in 2007. This is what the EU said Greece's real GDP growth will be, and this is what Greece's actual GDP growth will be. Significant difference. And everybody makes mistakes. You know, I made a mistake back in 1982 once. You know, it happens, okay? But this is a consistent mistake for several years in a row. Consistent mistakes, you know, even I don't make those. So, going through what the Japanese, in my opinion, did wrong and what I think potentially a lot of the European sovereign states would do wrong, that brings us back to the Japanese question. Did the delay and pray tactic of the Japanese work? Well, let's take a look at, did it work for the Japanese banks? Well, taking a look at history again, I always refer to history to get an idea of what's happening in the present. In 1990, you had the top 20 banks in terms of market capitalization. Out of the top 20, 90% of them were Japanese, 18 out of the top 20. Basically, Japan ruled global banking. In the year 2000, 5 of the banks were in the top 20 market capitalization. In 2003, how many left? None. It's arguable that Nomura might have been in, but to an M&A, it could be that there were, you know, an M&A transaction. It could be argued they were there in name only. Best case scenario, let's suppose they were there. They went from owning global banking to not being a participant in global banking. And the reason is they never fixed the banking system. Despite that, the Japanese government swallowed significant NPAs, non-performing assets, and became arguably insolvent themselves. Before the unfortunate fiasco of the last few weeks in Japan, Japan had a debt-to-GDP ratio of 200%, which is the highest of all developed nations. The reason why they don't have a run on their bonds is because a significant amount of their debt is owned internally by individual investors. So it makes it much more stable than, say, Greece, where a majority of Greece's bond holdings are held abroad. So chapter 3, we enter financial contagion, what I call the interest rate and currency storm. Again, like I said earlier, I'm not big on predictions. My crystal ball really ever works. But if there's anything I can bet the farm on, it's that interest rates are going to go up. We went through the high correlations of the equity markets in terms of volatility and debt markets and yield. In the Euro area, in the European Union, you have a very, very strong interlocking of foreign claims. That interlocking of foreign claims leads to contagion. That contagion leads to the domino effect. One country falls, and it makes others fall. It doesn't necessarily matter how big the country is. For instance, a lot of people have told me that, and a lot of experts have told me that Portugal is too small to cause damage. But Portugal is held and is levered by several other institutions. One of them is the ECB itself. Portugal by itself couldn't do harm to the ECB, but if Portugal defaults, What are the chances that the rates will be so high that the other, I don't want to say profligate, but allegedly insolvent nations won't be able to access the public markets for the near term at all until they restructure? And if they restructure, interest rates go up. You know, there's no choice but for interest rates to go up no matter which way you look at it. And if you go through, this is basically a map of foreign claims against Portugal, Ireland, Italy, Greece, and Spain. And you can see where France has significant exposure to Greece, Germany has significant exposure to Ireland, the UK is heavily exposed in Ireland, you have significant exposure from France into Italy, et cetera, et cetera, et cetera. As a percent of GDP, you can look at Belgium at 25% exposed to these four entities. You have Ireland at 41.8%, and you see the result of that. High correlation, again, plus high interdependencies leads to the path of contagion. Contagion is very, very difficult to predict. Even if you go through to this chart and you look at financial interdependencies, it's very difficult to predict because contagion does not necessarily follow the dollar, because there are a lot of other variables that come into play. Contagion, or significant contagion, in my opinion, is going to guarantee default. Now, they can dress the word up and they could say it's not default, but it's a restructuring. But again, if I have a deal where I'll owe you 10 euro at the end of the day, and I say, well, I can't pay you by the end of the day, but I will pay you by the end of the week, and I'm only going to give you 9 euro, then I defaulted because I didn't honor the deal. So you call it restructuring, but it's a default. Okay? What we've done is we've went into the austerity packages that Portugal and a lot of the other allegedly borderline insolvent nations have offered. We've marked their estimates to market. Their asset sales we feel were a tad bit optimistic. And we ran calculations to see what losses would be for investors. I don't want to go through the whole chart, but basically we have two tranches. We have one with no haircut or no discount on the principal amount, which is useless because that doesn't assist them in their debt service. And then you have another one involving a haircut. So we have a decline in net present value of cash flows to investors of between 34 and 35%. That's significant. Remember, those investors are levered. Minimum levered 10 to 1, most likely levered somewhere around 24 to 36 to 1. 36% leverage, 35% loss. Now you can see why a lot is being done to save a very small country like Portugal. Portugal can easily kick off the interest rate storm that I say is coming. Okay, so solutions. You've heard me complain. I'm up here, I'm telling you this is wrong and that is wrong, and what the Japanese did and the European nations. Well, we do have solutions. One is enabling people who have exposure to real estate to buy and sell risk. Okay, so their advantages are significant. Imagine if you had a building, but you didn't want to sell the property or the portfolio properties, but you were concerned about devaluation or the interest rate storm. We've created ways or creating ways to actually sell off the risk in your portfolio to someone who takes an opposite side or opposite perspective. We call these macro options. And basically, the macro options take all the analytics that I went through earlier in the presentation, and they enable borrowers to entice lenders by selling off risk. You take the option, you say you can sell off X amount of risk in this building to somebody else, and that person purchases the risk, and you have cash for it. If their viewpoint pays off, they get paid. If it doesn't pay you off, you keep the cash. Very similar to equity options. That can potentially, I'm not a lender, but potentially entice lenders for loans. It can also give speculators the ability to gain exposure to markets that they normally wouldn't have exposure to. And allow them to do that without actually purchasing the real estate or the real assets. It can also give them exposure to markets or into market where they feel that someone, a doom and gloom guy, might have gotten carried away due to FUD. FUD is what they call fear, uncertainty, and doubt. So you get exposure and you get a hedge. It also, with a slight tweak, allows landlords to value vacancies. using option theory and contingent pricing. And finally, it gives financial entities a way to lend at lower cost, but diversifying risk. This is a little complex to go in detail now. I only have about 4 minutes left, but I'm going to run through it. Here's an example of where you can have a portfolio of companies, and we use all the analytics, taking into consideration contagion, redundant risk, the bankable book versus a tradable book versus potential write-downs, and the statistical probability of write-downs and defaults. We put all this in, we map it per geographic area, and you can actually build your portfolio based upon exposure. So you can have a portfolio macro option, or you can have an individual macro option. And we could customize it geographically down to a particular building. We put it in, right? It gives you an additional spread over your expected yield or cap rate, and then you run that through standard discounted cash flow analysis. And it gives you basically the amount that the option will cost, okay, to buy or sell said risk. It also aids pricing, buying, and selling vacant assets, like I said before. Basically, someone purchased an option that vacancy will perform or not perform. You take the premium for the option. Either you're right or he's right.